Preparing for Islamic banking interviews at Dubai Islamic Bank DIB interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer, followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work for Dubai Islamic Bank? I'm interested in DIB because it combines scale with a clear Islamic banking identity. It is not just offering conventional products with different labels. The business is built around Sharia-compliant financing, customer trust, and strong UAE market relevance. For my role, I can contribute through sound analysis, disciplined execution, and service quality. I also like that DIB is investing in digital banking, which makes the customer experience faster while keeping Islamic finance principles central. While answering, focus on DIB's position as a leading Islamic bank, its UAE and international footprint, customer-centric transformation, Sharia-compliant values, and how your skills fit the specific role. Question 2. How is Islamic banking different from conventional banking? The core difference is the treatment of money and risk. A conventional bank lends money and charges interest, while an Islamic bank structures financing around an underlying asset, service, or partnership. Profit can come from a Murabaha markup, Ijara rentals, or Musharaka profit sharing, but it cannot be guaranteed interest on money alone. In practice, the bank still manages credit and liquidity risk, but every product must also pass Sharia governance and documentation standards. Make sure to cover the prohibition of riba, asset-backed transactions, risk sharing, Sharia board oversight, and how profit is earned through trade, leasing, or partnership, rather than interest. Question 3. Can you explain how a Murabaha financing structure works? Murabaha is a cost-plus sale, used when a customer needs financing for an asset. The bank first buys or takes constructive ownership of the asset, then sells it to the customer at cost plus an agreed profit margin, payable immediately or over time. The markup is disclosed upfront, so the customer knows the total price. The key point is sequence. The bank must own the asset before selling it. Otherwise, it starts resembling an interest loan. In your answer, talk about Murabaha as a cost-plus sale, the bank's asset purchase, disclosed markup, deferred payment, ownership transfer, and why documentation timing matters for Sharia compliance. Ijara is essentially Sharia-compliant leasing. The bank owns the asset and leases its usufruct to the customer for agreed rentals. Because ownership remains with the bank during the lease, ownership-related risks and major maintenance usually sit with the lessor, while operational use responsibilities sit with the customer. In an Ijara ending in ownership, the asset is transferred at maturity through a separate sale or gift arrangement. That separation keeps the structure compliant. Be sure to mention leasing mechanics, asset ownership, rental income, maintenance responsibilities, transfer at maturity in Ijara wa Iktina, and how risk differs from a standard loan. Question 5. If a customer says Islamic profit rates look like interest rates, how would you respond? I would explain that the customer's cash flow may look similar, but the legal and Sharia basis is different. In Murabaha, for example, DIB earns profit by selling an asset at a disclosed price, not by charging interest on money lent. Benchmarks may be used for pricing competitiveness, but the contract remains asset-based and approved through Sharia governance. I would keep the explanation simple, transparent, and focused on what the customer is actually agreeing to. While answering, focus on explaining clearly without being defensive. Profit rate benchmarking, fixed contractual sale price or rentals, Sharia structure, transparency to the customer, and regulatory fairness. Question 6. How would you assess the creditworthiness of a financing customer? I start with ability to repay, not collateral. For an individual, that means salary stability, debt burden ratio, bureau history, and account conduct. For a business, I focus on operating cash flow, leverage, working capital cycle, management quality, and sector risk. Collateral improves recovery, but it does not replace repayment capacity. In an Islamic bank, I also check that the financed asset or purpose is permissible, and that the product structure matches the customer's actual need. Make sure to cover repayment capacity, cash flows, collateral, industry outlook, existing obligations, bureau checks, conduct of account, and the additional need to validate the Sharia structure. Question 7. What steps would you take if an Islamic financing facility becomes non-performing? For a non-performing facility, I would first identify why the customer is stressed: temporary liquidity issue, structural decline, fraud, or poor documentation. Then I would assess recoverability through cash flows, collateral, guarantees, and restructuring options. In Islamic finance, late payment penalties are sensitive because they should not become extra profit for the bank. They are often directed to charity where applicable. The goal is disciplined recovery, fair customer treatment, and accurate provisioning under the bank's policy. In your answer, discuss early warning signals, restructuring options, collateral recovery, provisioning, customer communication, and why late payment charges must be handled carefully under Sharia principles. Question 8. How does International Financial Reporting Standards 9, expected credit loss provisioning, affect a bank like DIB? International Financial Reporting Standards 9 requires banks to book expected credit losses before a default actually happens. Facilities are typically grouped into Stage 1, Stage 2, or Stage 3, depending on credit deterioration. The model combines probability of default, loss given default, and exposure at default, adjusted for forward-looking economic scenarios. If a portfolio weakens, provisions rise and profit falls. For a bank like DIB, strong credit discipline directly protects both earnings quality and capital strength. Be sure to mention expected credit loss, staging, probability of default, loss given default, exposure at default, forward-looking macro assumptions, and why provisioning affects bank profitability. Question 9. Why are CASA and customer deposits important for an Islamic bank? CASA matters because it gives the bank a stable, relatively low-cost funding base. In Islamic banking, current accounts may be treated differently from investment accounts, where customers expect profit sharing based on an approved pool. The commercial outcome is similar. The stronger the deposit base, the more efficiently the bank can fund customer financing. Good relationship management, digital convenience, and salary accounts all help DIB improve liquidity, margins, and cross-sell opportunities. While answering, focus on low-cost funding, current and savings accounts, investment deposits, profit-sharing expectations, liquidity management, and how stable deposits support financing growth and margins. Question 10. What are the key AML and KYC checks you would perform during customer onboarding? AML and KYC are not box-ticking. They protect the bank, customers, and financial system. I would verify identity, beneficial ownership, source of funds, expected account activity, sanctions exposure, and PEP status. After onboarding, transaction monitoring should flag unusual patterns such as rapid fund movement or activity inconsistent with the customer profile. If something looks suspicious, I would document facts and escalate through the proper channel rather than alerting the customer. Make sure to cover customer due diligence, source of funds, sanctions screening, politically exposed persons, transaction monitoring, escalation of suspicious activity, and balancing compliance with customer experience. Question 11. What is the role of Sharia governance in an Islamic bank? Sharia governance is the control framework that ensures Islamic products are genuinely compliant, not just commercially renamed. A Sharia board reviews structures, contracts, and product features before launch. Internal teams then ensure execution follows the approved sequence, documentation, asset eligibility, and profit treatment. If a transaction is non-compliant, the issue is not only legal, it can damage trust. For DIB, Sharia credibility is part of the brand and customer promise. In your answer, talk about the Sharia board, product approvals, audit review, documentation discipline, permissible assets, and the reputational risk created by non-compliant transactions. Question 12. Which financial ratios would you review to evaluate a bank's performance? I would look at profitability, asset quality, capital, and liquidity together. Profitability includes net profit, margin trends, fee income, and cost-to-income ratio. Asset quality means non-performing financing, coverage, write-offs, and concentration risk. Capital adequacy shows the bank's loss absorption capacity, while liquidity and deposit growth show funding strength. No single ratio is enough. A bank can look profitable, but still carry hidden credit risk or expensive funding pressure. Be sure to mention net profit margin, cost-to-income ratio, non-performing financing ratio, coverage ratio, capital adequacy, return on equity, liquidity, and deposit growth as core banking indicators. Question 13. How would you handle a financing request from a business that may not be Sharia compliant? I would handle it respectfully and factually. If the business activity is clearly prohibited, I would explain that DIB must follow Sharia and regulatory policies, so we cannot provide that facility. I would avoid moral language and focus on bank policy. If there is a compliant alternative, I would explore it. If the case is borderline, I would escalate to Sharia or compliance. The key is protecting the bank while maintaining a professional customer relationship. While answering, focus on professionalism, explaining policy without judgment, offering compliant alternatives where possible, documenting the decision, and escalating borderline cases to compliance or Sharia teams. Question 14. Why is digital banking important for DIB's future growth? Digital banking matters because customers now compare banks with the best apps they use, not only with other banks. For DIB, stronger digital channels can reduce branch load, speed onboarding, improve service quality, and generate better data for cross-selling. But convenience cannot weaken controls. Identity verification, fraud monitoring, consent, cybersecurity, and Sharia-compliant product flows must be embedded. The best digital experience is fast, simple, and controlled. Make sure to cover customer convenience, straight-through processing, lower cost to serve, fraud controls, data analytics, personalization, and the need to keep digital journeys compliant and secure. Question 15. Tell me how you would manage pressure when a customer wants urgent approval but documentation is incomplete. Under pressure, I separate urgency from risk. If a customer needs quick approval, I would prioritize the critical checks first: KYC, eligibility, credit facts, documentation, and Sharia structure. I would communicate realistic timelines instead of promising something I cannot control. If information is missing, I escalate early rather than guessing. Speed is important in banking, but a small documentation shortcut can create credit, compliance, or reputational issues later. Be sure to mention prioritization, reconciling facts, involving the right stakeholders, communicating early, avoiding shortcuts in documentation, and protecting both customer experience and control standards. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.